Okay, good afternoon. Today is Monday, September the 8th, and I would like to go over a current position that I have in MGM and subsequent adjustments that I made after I initiated this particular structure. All right, this trade is somewhat related to a lot of the bad news pertaining to fewer and fewer tourists visiting the Las Vegas Strip for various reasons, most of them relating to exorbitant prices for all kinds of things. Water, hamburgers, soda, french fries, seeing the Wizard of Oz at the Sphere, so forth, so on. People are not feeling as welcome as they once did, and it makes them feel less hopeful about going there, less hopeful than they once did. Anyway, that being said, I initiated a position last week, I believe it was. Let me double check. So actually it's been a couple of weeks. So this was done in the middle of August, on the 15th of August. I started to put together a ratio spread, a 1x2, and I did it 2 times, where I sold 33 put, and I bought 2 30s. So the ratio is 1x2, and the expiry, by the way, of these is September the 19th. If we take a look at the risk profile of this position, you'll note that since it was initiated for a small credit at prices above 33, I get to keep my credit at expiration, and prices that are bounded by, and the prices in the underlying I'm referring to, they're bounded by 33 and 27. I could lose some money with the max loss being at a price of 30. Okay, so anyway, shortly after I initiated the trade, MGM started to rally. So the market did not care about the woes and the complaints of visitors to Las Vegas, because the casinos, particularly Wynn, MGM's not doing too badly. I'm not going to get into the financial statements, but they're having a good year. And the high-level execs, they're having a great year. Market rallied. After that, what I decided to do was adjust the position, because it became attractive for me to turn this ratio spread into a butterfly. And note that currently I'm short 233 puts, and I'm long 4 puts at the 30 strike. So these 2 that I'm short at 33 could easily become part of a butterfly if I buy a put at a strike higher than 33. Let's say 36. What would be my position if I did that? Well, if I bought the 36, note that I would have a 1, long 1, short 2 at 33, and long 1 at 30 plus an extra 3. So here's a butterfly, a 1x2x1 with an extra 3 puts at the 30 strike. I ended up buying a 36, but in addition to that, I sold a call at the 41 strike. And when I did that trade, buying a put at the 36 strike and selling a call at the 41 strike, that was done for a small credit. Okay, so we have initially we had, let me go through this. We had the ratio spread, which looks like that, with my max loss being at the 30 strike. I went out to the 36 put, and I bought that, and that converted this into a butterfly with 3 puts that I'm long at the 30 strike, and I also sold the 41 call. Now, this leaves me with this leaves me with a bit of risk to the upside, because this risk is uncapped. Should MGM rally, and should it rally a lot, I'm going to lose possibly quite a bit of money, depending upon the magnitude of the move to the upside. So what can I do about this? Well, remember when I bought the 36 put and I sold the 41, I did it for a small credit. I did it for a very small credit, 8 cents, which is fine. So in order for me to, if I want, completely eliminate this risk to the upside, I can buy the call in, and let's say I paid 5 cents for it, that would still leave me with a small credit, and the risk, the subsequent risk, would be the following. All right, now notice that there's no risk to the upside. We have the butterfly centered at the 33 strike, and at the 30 strike, this is the end of the butterfly with an extra 3 long puts, but the risk there is eliminated. I do not have to have this constraint where I'm buying the 41 call to eliminate the risk. What if I did this? Remember, I did this 36.41 for 8 cents. What if I paid, let's just stick with 5 cents. What if I paid 5 cents tomorrow or later on this week for this 40 call? Well, this creates a long call vertical. So if I pay 5 cents for it, the risk profile suddenly becomes this. We have a long call vertical where, should it rally, I will make the $100 on this call vertical plus the credits I received for the earlier components of the trade. If it goes down in price, the underlying goes down in price, and I pin the tail on the donkey at 33, then I have a potential profit of a little more than $300. If it goes to 30, it's going to be a small win for me, but still better than a loss. And if we have a sharp move to the downside and the magnitude is decent and the timing is right, so this happens at or near expiration, then this trade has a lot more potential because I'm going to be long 3 puts from the 30 strike and 3 contracts, 3 of these puts. That would be the equivalent of 300 contracts of MGM. And if they happen to go down to 20, then I can make a little more than $3,000. But for the meantime, I still have this risk to the upside and 41 call, which I am still currently short. So that is something that I will deal with later on this week, probably by doing something like that where I buy the 40 put and I'll have a long call vertical here to make a little extra money, or who knows, maybe I'll just close out this call and not worry about it at all. Well, not that I would worry about having a long call vertical, but just eliminate the whole thing there, and depending on the price I pay, leave me with this should end up being still a bit of a credit if I pay less than 8 cents for it, because that's what I did the 36.41 trade for. This would be, yeah. So it would leave me with a small credit, which is fine, but I would actually prefer to buy the 40 and have it look something like this. It all depends on where this trades tomorrow or after tomorrow, should I decide not to do anything tomorrow. We will see. All right, those are the adjustments that I made and the adjustments that I'm thinking of making. Hopefully that was helpful as far as ways to look at dealing with risk and how to adjust trades as time marches on closer and closer to expiry. All right, that's it for today. I will catch you guys next time.